Hello and welcome to my channel. In my last video, I discussed about the NBFC, monetary aggregates and financial market, where I have discussed about the different NBFCs which were deposit wise, function wise and some other types. And I discussed about the monetary aggregates which were MO, M1, M2 and M3. And I discussed about the financial market where I have discussed about its structure, about money market and capital market. Under the money market, I discussed about the organized and unorganized sector, where I have discussed about the call money, call market, short notice market, CBLOs and CPEs. In this video, I am going to proceed further and going to discuss about the financial market and capital of the company, and I am going to discuss about the participatory capital, non-participatory capital. In the participatory capital, I am going to discuss about the preference share and equity share. In equity market of India, I am going to discuss about the IPO, FPO, OFS, private placement, QIP, and right issue. And about the old issue market also I am going to discuss. So what are we waiting for? Let's start with the first topic, which is the cash management bills. Cash management bills were introduced in the year 2010. They are almost similar to the treasury bills with the following two differences. First, their time period is less than 91 days and they are non-standard in the sense that there is no fixed standard regarding their time maturity. Next is the cold money market in the market for overnight money among banks. In other words, we can say that in this market banks exchange funds for one day. Next, in the notice money market, banks exchange funds for the period of more than one day but up to 14 days. In the interbank term money market, bank exchange funds for the period of more than 14 days but up to 1 year. Now let us proceed with the capital of the company. We have to understand first what is the capital of the company. In the business, capital means money. A capital needs to function and to expand. Typical example of capital of include cash at hand and accounts receivable. Near cash, equity and capital assets. Capital assets are significant long-term assets not intended to be sold as part of your regular business. Now in this I am going to differentiate in two parts. First is the participatory capital and the other is the non-participatory capital. The participatory capital is the share capital, or we can say the collected through share, whereas the non-participatory capital is the debt capital, which is in the form of bonds and debentures, etc. Now let us understand what is the participatory capital. Participatory capital, as I have mentioned, it is the share capital, or we can say the collection through the share. It is again divided into two parts, which is the equity share and preference share. Now we have to understand what is the equity share and the preference share. To understand that, I am going to make differences in between them. First, let us understand about the differences, like a preference is given in the profit distribution and also after liquidation of the company. So the people who are having the preference share, they are going to get the profit distribution also after the liquidation of the company, whereas those who are the equity holders, they are not going to get any such preferences. Second difference is that the profits are fixed in advance. So the people who are having the preference share, their profit is always fixed, whereas those who are having the equity share, they are not, their advance fixation is not done. Third is there is no participation of the preference shareholder in the losses, whereas those people who are the equity holders, they have to participate in the losses also. The preference shareholder, they do not participate in any of the liabilities, whereas the equity shareholder, they have to participate in the liabilities. And there are two categories in this aspect. First is the limited company and the second is the unlimited company. The limited company, they are going to pay the liability up to their face value but not more than that, where those who are having the unlimited company, they are not having any limit, so they can pay up to what there is liability, what is their capability. Now last difference is that the preference shareholder, they do not have any right to vote, but whereas the limited company, they are having the right to vote, or we can say the people who are having the equity shareholding or they are having the equity share, they are having the right to vote. Now let us proceed further and understand What is the stock split? Actually, whenever we are sharing the profit is being shared by the equity holder as well as with the preference holder also. But suppose the profit is very high and in the market the share price is hiking. So what the company is going to do? The company is going to split the stock so that the people are will be able to buy the stocks. So in this, what they are doing, the company is increasing the number of the share to boost the stock's liquidity. Although the number of shares outstanding increases by a specific multiple, the total dollar value of all the shares outstanding remains the same because the split does not fundamentally change the company's value. So if suppose the share value is 10,000 and they are going to split into 10 parts, now each share is going to become 1000 rupees only. So the value of the share will remain the same for the 10,000 only. Now a split there is no change to the company total market capitalization as the price of each share will split as well. The most common split ratio are 2 is to 2 for 1, or we can say other one is the 3 for 1, which means every single share before split will turn into multiple shares after the split. A company elects to perform a stock split to intentionally lower the price of single share, making the company's stock more affordable without losing value. As I have made you understand that they are going to increase the number of share, but the value of the share is going to be splitted so that the value of the share will remain the same in the market. Now, but it will be affordable for the people to buy that. So they are not buying one share; they are buying one part of the share. Now, next I'm going to discuss about the equity market of India. The equity market of India is having two parts. One is NIM, which is known as New Issue Market, and other is OIM, which is also known as Old Issue Market. The NIM is also known as the primary market, and OIM is known as the secondary market. Now, let us understand the primary market and the secondary market. The primary market is where the financial journey begins, where the companies stop onto the stage of capital market for the first time funds. In this market, they issue new securities such as stocks or bonds to investors, effectively allowing them to buy a piece of company. It's like buying a ticket to a blockbuster movie before it hits the theater, giving a chance to own a part of action from the very beginning. Now let us understand what is the secondary market. Secondary market is the market where the shares are in the hand of investors. They often find their ways to secondary market, and this is where the securities are traded among the investors. Now secondary market is where the action never stops. Means it is like SEBI, they are going to resell the same stock, and they are by this the market price of the share is going to get increased. Now let us understand the different parts of or the different equities of this NIM, which are the IPO, FPO, OFS, private placement, and QIP and right issue. I'm going to discuss about each one of them one by one. Now let us discuss about the IPO. When the private company first sells the share of stock to the public, this process is known as the initial public offering, which is IPO. In essence, an IPO means that the company's ownership is transitioning from private ownership to public ownership. Next is the FPO. A follow on public offer is when the company already listed or an exchange issues new shares to investors. The offer is an issuance of additional shares made by the company after the initial public offering. Follow on public offering and are also known as secondary offering. Next is the OFS, which is known as the offer for sale. Is the simplest method used by the promoters of the public companies, especially in India, to sell their shares through a bidding platform on the stock exchange, reducing their holding in the straightforward auction process. Next one is the private placement. It is the sale of stock shares or bonds to pre-selected investors and institutions rather than publicly on the open market. It is an alternative to an initial public offering for a company seeking to raise capital for expansion. Next is the QIP, a qualified institution placement, is at its core a way for listed companies to raise capital without having to submit legal paperwork to market regulators. It is common in India and other southern Asian countries also. Next and the last one is the right issue. A right issue is where a company offers its existing shareholders the chance to buy additional shares for the reduced price. Usually, the discounted price will stand for the specified time frame after which it will return to normal. Means for a time period they are going to reduce the price of a stock for the people, and after some time they are going to increase the price of the stock. Next is the old issue market, as I have mentioned, is a part of equity market of India, which is also known as secondary market. Here the investors get liquidity and the already issued equities are transacted, and we can say that these are the stock exchanges like BSE, NSE, etc. By this I am concluding my video, and if you find my channel interesting, kindly like, share and subscribe. Thank you.